Managing a bull put spread. So the first thing I want to bring to your attention is that a trade can be closed at any stage by simply buying back the short put and selling the long put. And it's normally closed down as a combination trade. It's very easy to do. And we'll show you how to close down a bull put spread in later videos. But there's three possible scenarios when we get to expiry Friday. We would normally leave our bull put spreads until expiry Friday unless there was something untoward that we wanted to change. And in this scenario, if the share price is above your short strike price, well then you've achieved your full profit and you've nothing to do. So let me just show you that there. So you'll have nothing to do as long as the share price of the underlying stock is above the short strike price. So no need to do anything. What will happen is your positions will disappear on the Saturday after expiry and you'll just keep your full profit. However, if we get to a situation where the share price has dropped substantially and the share price is now trading below the long strike price, you're in a full loss situation. Now, you have two choices. You can do nothing and just take the loss. What will happen is your positions will disappear on the Saturday as well. Interactive brokers in the background will make all the offsetting trades and you'll achieve your full loss. Or if you believe the share price is going to eventually rise again above your short strike, you could just roll out the trade for another month. And we're going to show you a video on how you would actually do that later on. So there are your two options. How you actually deal with the situation depends on what your outlook for the stock is in this particular scenario here. And then finally, if the share price is trading between your long strike and your short strike at expiry, you're either in a partial loss or a partial profit position. So what you need to do in that situation is close down the trade before the market close on expiry Friday, because what will happen is if you don't, is that you're going to be assigned the shares on the short strike because your long strike is going to finish out of the money and worthless. So what you need to do is close down the trade at expiry Friday. So it's only really in that scenario that you have to do something at expiry Friday. In the other two, you may or may not decide to close the trades down.